Hello everyone, welcome to Khali FP&A channel. Today we're diving into the crucial topic of key performance indicators. Let's explore 7 critical KPIs that every restaurant should keep track of. Let's do this. Key performance indicators are measurable values that demonstrate how effectively a restaurant is achieving its key objectives. They provide insight that help you make informed decisions, optimize operations, and ultimately increase profitability. Our first KPI is the food cost percentage. This metric shows us what the total cost of food is as a percentage of sales. Generally, it can range from 28 to 40%, meaning that of all your sales, one should expect that 28 to 40% of your sales is going to go to cost of the food. And it's got a very simple formula. Food cost percentage is equal to the cost of food or cost of goods divided by your sales times 100. And this ranges from 28 to 35%. Let's look at a theoretical example. If your restaurant has sales of $10,000 and the financial statements show cost of goods sold or the cost of food sold is 3,500, it means that your food cost percentage is your cost of food 3,500 divided by your total revenue, your 10,000, which gives us 35%. This is this is actually at the upper limit of the normal range that is expected. This 35% can be lowered by, for example, managing your waste. The less waste that you have, the more revenue that you're going to get from the inventory that you have. So the lower the food cost percentage, as long as quality remains the same, as long as the quantity of food portions remains the same, then the lower the food cost percentage, the better. Next, we are going to look at our labor cost percentage. This is similar to your food cost percentage, but instead of looking at the food cost, we're going to be looking at the labor cost. For restaurants, this generally ranges from 25 to 35%. Going back to our theoretical example, you have sales of $10,000. Then you have your labor cost at $2,700, which means your labor cost percentage is 27%, which is within the range expected for a restaurant. This labor cost percentage can be managed, it can be reduced by, for example, training your waiters to upsell. For every customer that places an order or asks for something on a menu, your waiters then suggest something for the customer to buy extra. In other words, each waiter will be bringing in more revenue for the same salary that they get. As with the GP percentage that we looked in our first video, the labor cost percentage also differs from restaurant to restaurant. Your quick service restaurant, for example Chicken Inn, will have lower labor cost of sales because of the lower headcount that they have in serving their customers. It's just basically 2 to 3 people standing by the counter and serving all those customers that come through. So obviously that's a lower headcount and a lower labor cost percentage. Next category that we would like to look at is casual dining. For example, the Boma at Vic Falls. The expected labor cost percentage for such a restaurant is 25 to 30%, which is slightly higher than your quick service restaurants. This is because obviously there's more people expected to serve as waiters in your casual dining experience. The last category that we're going to look at is your fine dining restaurant. These ones have a higher labor percentage cost, sometimes exceeding 30%, because of the higher skill required in these fine dining restaurants. One example of a fine dining restaurant is La Cream in Bulawayo. Monitoring this KPI ensures that staff costs are aligned with sales. This can be improved if management of a restaurant improve their skill in anticipating customer volume. So the higher the customer volume, the more the staff cost. And if they can accurately estimate a lower customer volume, then they will not need that much staff members to come and report for duty, thus reducing your staff labor costs. The third KPI is your average transaction value. This reflects the average amount that a customer spends when they come to your restaurant. This can be calculated by dividing your total sales by the total customers served. A theoretical example, a restaurant in Bulawayo makes sales of 5,000. They look at the accounting system and they find that 200 customers have been served. The average transaction value is 5,000 sales divided by your 200 customers that have come through, giving us $25 per customer. It's an average. The higher the average transaction value, the better. It means that each customer is willing to spend more within your restaurant. How do you increase your average transaction value? There's different ways of doing this, but one of the easiest way is by, once again, training your waiters to upsell. Every time a customer comes in and places an order, your waiting team is trained to suggest other items which a customer can buy to accompany their meal, thus increasing the amount that a customer is willing to pay. Fourth on our list is the table turnover rate. No, we're not talking about the number of times that tables turn over in your restaurant as a result of a riot within your restaurant or because of an accident. A table turnover rate measures the number of times that a table is occupied during a service period. Usually, restaurants are happy with a table turnover rate of 2.5 to 3, meaning that at each meal service period, it could be lunch, it could be dinner, you have 2 to 3 times that the table is occupied by customers. The higher the table turnover rate, the better. Fifth, we have customer satisfaction score, where your restaurant actively engages customers to get feedback from them. Chipotle is one global restaurant that emphasizes the importance of getting customer feedback. You can actually go on their website and there's actually an online customer feedback form. They're constantly getting information from the customers. This helps them to identify the areas that they can improve. It also helps them to identify their strengths. It also helps them to keep improving their service delivery. Failure to do this means that discontent amongst your customers, areas that you are lacking, areas that need improvement, are not picked up by management, and you could lose your customers. Next is your return on assets. This KPI indicates how effectively your restaurant is utilizing its assets to generate profit. The higher the return on assets, the better. Industry average ranges from 5 to 10%, meaning for every $1 in assets that a restaurant has, the average is that $1 brings in 5 to 10 cents in profit. This is net profit, not a gross profit. For example, if a restaurant has assets worth 100,000 on its books, then if it has 5 to 10% return on assets, then at the end of the year, it should expect $5,000 to $10,000 in net profit. This is after all expenses, tax, and depreciation have been deducted. Monitoring your return on assets helps you monitor the way that your assets are acquired. You will not just go and buy an asset just for the sake of adding assets to your company. You will assess first, how will this asset help me generate profit? Is it a profitable move? Once you continue to do that, it means that you will manage your cash flows with regards to acquiring assets and make sure that only profit-generating assets are added to your business. Finally, we have your net profit margin. This shows what percentage of revenue remains as net profit within the business. The average net profit is from 3 to 5% for restaurants. Let us consider real-life examples. Once again, we'll look at Simbisa and we'll look at Nando's Global. Simbisa brand's net profit margin was 7.2% and 5.4% respectively for 2023 and 2024, whilst Nando's Holdings had a net loss margin of 7% and 4.2% respectively. By understanding and optimizing these matrices, you can improve your profitability and hence your long-term success. Don't forget to like, to subscribe, and to share. We will continue to release more information that is beneficial to restaurant owners and managers. And remember, you got this.